You have spent an entire semester now learning about all classes of financial assets and the markets in which they're traded, their suitability for long-term retirement accounts, their suitability for short-term trading, and the like. So by now, it's time for us to sit back and assess, what can you do with this information? This little simple video is designed to prompt some consideration on your part about that question. I've decided in this video to keep it real simple and straightforward. I could raise these very same issues included here with all kinds of fancy math, but I don't think it's necessary to do. I have 4 or 5 points I want to make here, and I want you to start thinking about some of the issues I raise here, because you are now equipped to use the information that you have learned in this class to prepare your own financial management. And so I'm hoping that by now you'll start thinking about how you want to do that. Here's what I'm going to discuss. I'm going to ask you to consider your level of involvement in your own financial management. As you go forward, many of you will get married and have a family, and so at some point this will involve the consideration of a spouse and the like. So maybe it's time for you to start thinking about how you might do that. I'm going to discuss some very elementary investment targets that you need to think about if you're starting to save at a young age. I'm going to stress, as I have throughout this class, the cost of having other people do it for you. And I'm going to try to dissuade you from allowing others to do it for you by showing you the impact of fees and returns of managed funds in the long run. Then I'm going to encourage you to develop a type of positive investment attitude through what I simply call, for lack of a better term, holistic investing. And then I'll enumerate some decisions that, in my opinion, you should make as soon as you graduate. As far as I can tell, you have 4 possible levels of involvement in your own financial planning. You can generally ignore the pictures in this slideshow, by the way. They're just there to amuse you. They have nothing to do with the discussion. If you really don't like this stuff, if this approach to finance is cynical, then you can remain uninvolved. You can hire someone else to do it for you. But I've warned you, and you know that the warning is valid. There are significant issues with the competence of advisors and the fees they charge. So if you stay uninvolved, you're going to have to take that into account. You can, I think, get by very well, actually, with a passive strategy, which means you'll sort of seldom look or decide on your portfolio. You'll follow very simple investment rules, like you may say a simple family of mutual funds, 60-40, equity and bonds, or something like that. And believe me, you can probably do all right with that kind of strategy. You may decide to become a little more active, which in my mind would view at least a quarterly portfolio review with your spouse, if a spouse is involved, with the consideration of rebalance toward meeting your financial objective. And by that I mean, if you have set a 70-30 portfolio 2 years ago, and now it's at 80-20, you may want to consider rolling it back to 70-30. We discussed that in an earlier lecture. Finally, you can be aggressive, and you can become aggressive in various degrees. You can be fully involved with markets all the time, at least monitor the indexes on a daily basis. And you can trade at whatever level you think is an active level, including managing a stock account or even an account with derivatives. An aggressive market can simply be a mutual fund market or an exchange-traded product market. It does not have to involve derivatives. It requires your very frequent attention, and in most cases, the development of a portfolio with at least some portion of your funds, say 15 or 20%, that is involved in a high-risk profile. That's the way I do it, by the way. So here's the most elementary question you're going to want to address when you get your first job. How much should I be saving or socking away? And this fortunately includes contributions to your retirement account like your 401k. And here's the best advice I think I can give you. Save just as much as you can possibly afford and are comfortable with. You've heard me advise you to sort of postpone the purchase of the expensive car and such things as that until at least after your house is purchased. If you go to a financial advisor, they'll ask you in many cases to take on an income or lifestyle survey. I don't really think they're worth the time of doing it unless you're above age 55, and then it may be too late for the survey to do you much good. There are simply too many unknowns that you face right now. Who knows what your career path is going to be? You may or may not inherit a great deal of money, which will obviously make this easier. You'll have to decide whether you will or won't have kids and where you're going to educate them and have to bear the cost of raising kids, which, by the way, from experience is worth it. We know really very little about the status of government support programs, in particular Social Security and Medicare. You've heard lectures from me that claim they're underfunded for your generation, and I can easily demonstrate that. We don't know what level of home equity you're going to have in 25 years, and the status of your medical care, impact of economic events, so there's no really good reason for you to sit down and have a very specific plan at age 21 or 25 or even 30. I think as a general rule, you should make maximum contributions to any employer-subsidized retirement plan that's offered to you. I've said that many times. You should try to contribute amounts beyond that to a Roth IRA or a spousal IRA or some kind of tax-deductible account if you can. And even if you can't get the tax breaks, still try to save a little bit past that in later years as your income rises. I think it's important that you also develop a personal culture or a family culture of parsimony and involved attention to financial health. You may already do this for physical health or religious health or emotional health, so why not add to that and do it for your financial health? Okay, you're math people. You're technicians, you want a formula. I actually have a formula. I'm not going to stick it here. I'll let you figure out the formula. What I have is the results of that formula and what it tells you, and I think I can convince you that this is a credible argument. Now, as I describe this, I describe all of these terms in real terms, meaning inflation adjusted. So when I say you may need $1 million by age 50, I mean inflation-adjusted dollars, which is to say that however nominal amount of money you're talking about, it would be the same that $1 million would buy currently. So that's easy to do in finance because you simply convert the discussion of yields on your investments to real yields, which is to say inflation-adjusted yields, and income to inflation-adjusted income. So when I talk about needing $50,000 a year when you retire or having $1 million by age 50, I'm talking about inflation-adjusted values. Once we accept that, then the formula is complicated, but you can probably figure out. It's just a compounding formula. If you plan to live for 30 years after your retirement, and you think you can earn 3% real returns on the remainder of your investment account once your retirement begins, you'll need 20 times your annual budget to have money for that 30 years. So, for example, if you have an annual budget after Social Security or other non-investment income of $50,000 per year, and that's pretty low, by the way, then you're going to need to have $1 million real terms at the start of the retirement period. Because as you draw down from that, it will last you for 30 years if you get a 3% rate of return real on the portion remaining in the investment account. Now, if you're a smart investor, a good investor, and you're able to earn 6% over the same 30 years, on the remaining investment account, then you only need 14 and a half times your annual budget. So on the right, you can see this very elementary little device. You take your annual estimated retirement budget, including the taxes that you will owe, and in most cases you will owe some taxes because retirement payouts and Social Security and any additional income is typically taxed. And you subtract your non-investment income like Social Security, which we hope is going to be there for you, but I wouldn't count on it being as strong as it is for my generation. You take the annual estimated budget, subtract non-investment income like Social Security or a pension fund or something. You multiply that times 20. That equals the required investment that you must have accumulated by the time your retirement starts. Now you can tweak these numbers a little bit to go a little past your retirement, a little early. You can see how compounding is being used here to make these estimates. So that begs the question, let's say it's $1 million. That was the example used on the previous slide. So then we ask, what does it take to get to $1 million? In real terms again. $1 million real, adjusted for inflation over these 40 years. Why 40 years, by the way? Well, if you start work at, say, age 22, we're talking about ending this at age 62. You may want to get a little more aggressive than that. You may want to work until 70. Now, let's assume, just for the sake of discussion, that you have a family income, which may only be you when you start out, of $70,000 a year. And let's assume you have an annual inflation-adjusted increase in that income of 1% per year. And that would be generous, but maybe not for people working in the technology industry. And let's assume that you have an investment rate of 8% of your income, whether that's 401k or voluntary, 8% of your income, and let's assume that earns 3% real, which would be something like 5 or 5.5% in non-inflationary periods. Or consider 10% of your income earning 5% real over 40 years. You can tell that if you start with 8% earning 3%, you're going to come nowhere near your target. And in fact, because of the impact of compounding, you can see that the slightly less aggressive plan produces only about 60% of the income of the more aggressive plan. It does take 10%, earning 5% real over 40 years, if you have this kind of income, to push it up above $1 million. Now, obviously, you have a higher income, then you have a higher target. But remember, this $1 million only funds $50,000 a year. So maybe you think you need $2 million to fund $100,000 a year or more. This is just a hypothetical example. It's fairly realistic. But you should see here that the earlier you start and the more aggressive you are and the better you are at getting some decent returns, the better this is going to turn out. Now, you've heard me all semester long talk about the negative effects of high fees. What you're looking at here is the earlier decision of 10% at 5%, hitting that 1 million at 81,000 mark. But if you have to get advice to do this, if you have to get a financial advisor to tell you how to get your 5% real or to set up your 10% deduction plan, you're not going to hit your $1 million if the advisor is using front-end or back-end load funds that charge 5%, and if your advisor is charging a 1% higher fee than you would be able to realize if you used your actual no-load fund. This is the way it turns out. The difference between the same exact rate of return at the same rate with a 5% load and a 1% higher fee over an investment earning 5% is nearly $400,000 on this target. It's because of the reality of this that, in my opinion, decision option number one, being uninvolved and hiring someone else to do all of this, for most of you, should be ruled out. You really get a huge amount of return to your time if you, at least on a quarterly basis, sit down and manage your own finances. You are paying a massive fee to people if you have them do it for you, and you very well may fall short of your investment goals unless you make a lot of money. This helps. I've talked about this earlier in the slideshow, somewhat in the class. It's what I call holistic investing, and I think you should apply it whether you want to be Scrooge McDuck, and Disney may ask me to take this video down if they see it, but I promote Scrooge McDuck, so they shouldn't. Or if you think this is something just managing a moderate, wonderful way of life, you can make managing your personal finances into an integral component of your personal and your family life. And I don't think it's all that hard to do. Most of you have already done this for something like exercise or spiritual or religious strength or even a diet and the like. And so you add this to that mix. You say, I like to manage my life and control my life to a great extent. So I have this sort of routine I go through that allows me to control my own life in the way that I like or in the way that my family likes. So you simply schedule time for family consideration of financial and investment matters, and you simply sit down and talk about it and think about it and make decisions just like you might go to the movies once a month. In this class, I have stressed investment decisions that are long-sighted, as though managing wealth for your grandkids, even if this is only for your retirement. I keep pointing out to you that if you start these practices at a young age, that if by age 35 you have $450,000 in your account, even though you don't plan to use it until age 65, that's going to make you a very happy person. It brings about a sense of well-being. Here are some of the decisions that you should make. Again, should I do this myself? Should I make someone else do it for me, like a spouse? Or should I hire a professional? Just checkbox which you want to do. If I build a mutual fund or exchange-traded product portfolio, should I build a managed portfolio or a passive portfolio of mutual funds? If managed, should I include stocks, sector funds, international funds, and leveraged ETPs? Should you get a little more aggressive in your investment to try to get your yield up by another percentage point or two? How much risk am I willing to take? And that's kind of a hard decision to make, but it will have some bearing. If all of this makes you uncomfortable, dial back the risk. Again, I've told you, if throughout the lifetime of people my age they had invested aggressively in only a 60-40 portfolio, they would have had far, far more than they needed to retire, believe me. Should I supplement my savings with a Roth or spousal IRA? You actually have to open one of these. They don't open for you when you go get a job. This is something you would have to do. It's a good sign when you take this kind of step. And then finally, remember, these markets sometimes really go south, which is one of the reasons why you want to have a diversified investment pool. You need to have real estate for inflation. You need to have bonds for stock market downturns. You need to have stocks for normal economic growth. But the latter especially really gets sour sometimes. So of course, again, I advise you, remember, maybe this is the best advice I can give you as a student. Don't panic when that happens. Try to see trouble before it arrives. But if you don't escape the trouble altogether, don't worry too much about waiting it out. These markets always recover after a period of time. Well, good luck on making these investment decisions.